Can you guys hear me?
Yeah, I can hear you.
Okay, can you see the share?
Low, David.
Can you hear the, or can you see the shared screen?
Yeah, it's the Zoom screen.
Yeah.
Yes.
Okay, so do you just want me to leave it like this?
Sure, that's fine.
I have my Zoom up. Heather, can you let me in?
I can't see everybody though. I can't see anybody.
I cannot see a shared screen.
Well, let me, you know what, I'm gonna stop the shared screen for now. But like I said, I can't.
It said you cannot start your video because the host has stopped it.
Yeah, so whoever's hosting needs to allow us to show video. Oh, I'm the host now. There we oh, I had it for a second. There we go. All right. I can see everybody's name. I just can't see your, which is fine. This means you guys are.
Yeah, sounds like you're a little low.
Let me see. I don't know.
I can't hear him at all.
Is that better?
A little, maybe that you and I are on. I'm gonna hang up with you, MJ.
Yeah, I can hear him perfectly fine.
Okay, perfect. It may be that we had a separate call.
Okay. So it does look like we're getting some attendees.
David, if you can go on attendees and put Maricela as a panelist. He's in blue, looks like, MJ.
Okay, that's done.
Thank you. You should be showing that.
Oh, okay, it says that I can't no video because the host has stopped it. That's okay. I don't need to be on camera. Can you hear me, David?
I can hear you, but again, it's not super loud.
Sounds clear on my side for MJ. And now you sound better, David, as well.
Yeah, David, you sound okay to me.
Okay, and then whenever you guys want me to share the screen, I'm ready to go.
Okay, if you want to go ahead and share screen, and then we'll have to let the attendees in, I think, possibly.
Do you think I have to let the attendees in?
I think that's what it is, because there wasn't a password, so you'll have to go click to let them in, and then MJ can just, as they're coming in right this moment, she can say, hi, welcome, welcome, and then she'll introduce you as you're clicking them in.
Yeah.
Okay, let me, so that's probably back under the,
Yeah, sorry.
yeah, that's okay. No, it just gives me an allow to talk or promote to panelist. So
If you want to go find South Bay Credit Union and send the host back over to me.
okay, yep, hold on. Okay, you're the host now.
Thank you. Okay, I'm gonna let them in.
Release the host.
Hi, everyone. Hi, everyone. Good evening. Thanks for joining. Just give us another minute and we'll get started. Thank you, everyone, for taking the time and joining us this evening. We're just going to let everyone in that's been waiting, and we'll be right with you.
Are we supposed to see everybody?
No, you're not going to see everyone. You're basically just going to see the presenter, David, and his slide here in just a second.
Okay.
Thank you. Great question, though. I'm sure others were wondering the same thing.
Are you able to see us?
No, I cannot. Do you want to be seen?
No.
I actually think it's better for everybody if I'm not seen, but I don't think that's allowed, so.
Thank you, guys. I think we might be ready to get going. Let me just introduce. Thank you again, everyone. My name is Marisela Jauregui, and I work with South Bay Credit Union. I know we have some other South Bay Credit Union representatives on the line with us. Rosemary, Yvette, who many of you may know already if you're members, as well as David Ellings. So we're all here ready to answer any questions you guys may have. David, who I'm about to introduce right now, comes to us with tons of experience. He will actually be the man of the hour conducting our homebuyer seminar. So again, thank you guys for joining. Appreciate it. I know it's crazy times, but this seems to be the new norm now, that we'll be doing a lot more videos, and I think it's nice when you get live. No one is seen right now other than David, who is on the screen now, and hopefully you guys can all see him. But David comes to us with 25 years in the financial industry. He's worked at several large investment firms. He really just has a ton of experience. His experience working in the investment firms have definitely helped him and be super instrumental and very successful as he's migrated over into the mortgage lending industry. So he's very confident that he can assist everyone here with any questions that you guys might have as it relates to mortgages, and just home buying in general. So please feel free to ask any questions. This is meant to be interactive. And thank you for joining.
Hello, everybody. And again, Marcela, thank you very much. That was a very nice introduction. That guy sounds pretty good, but I'm here to tell you, I don't know. So just we'll get this out of the way right off the top. Every single Zoom call that I do, I seem to always be under two lights that show up right here on my head. So I've tried to always get those somewhere else, but they just look like horns, and I apologize. So get that out of the way. Now, I'm going to share my screen here for the presentation that we have. And when I do this in live, it's very interactive. It's very conversational. It's very, people will stop me throughout and ask questions and things like that. So what I would ask is, I believe we have somebody kind of monitoring the chat function. So if you have a question, of course, we'll do some questions at the end as well. But, I don't want you to have a question and then we keep going and you forget. Throw that question out there. I guarantee you somebody else has the same question. And we'll definitely be answering those as we go along. The presentation is not super long, but it's not something that I don't hit on every single part of it in depth, because if we did, we'd be here for a couple of hours, and I don't think anybody really wants to do that. You can get this presentation, I believe, if you contact South Bay Credit Union. They have it and they can send the presentation out to you. I would suggest that because there are some things in this presentation that, again, we won't have either time to get to, or two, there's a couple of sheets in there, like you can track your spending, you can, there's information on credit and credit bureaus, things like that. So I would definitely suggest reaching out to South Bay Credit Union so they can send that out to you. And they can just, email. It's in a PDF or a PowerPoint, and it is a good presentation for you guys to take a look at. So I'm going to share my screen right now so we can get to the presentation, and away we go. So this is our first-time homebuyer. We call it a checklist. So table. So a couple of things that we'll definitely be talking about is be informed about your credit, understanding your financial picture, selecting a mortgage professional, research, first-time buyer programs, choose a mortgage loan officer, make an offer, and complete your loan process. So the things that I will tell you when I've done a lot of these first-time homebuyer presentations, or just homebuyer presentations, and the things that people seem to ask the most questions about are credit, down payment, and how much can I afford. So those are the ones that we'll be hitting on the most, and mostly go into a little bit further than choosing a mortgage professional or making an offer, things like that. So the first one is be informed about your credit. So everybody has credit, good or bad, everybody has it, but you really want to know it. And so the things that I talk about are, everybody gets or knows about Credit Karma, or you might have a credit card that gives you your credit scores. The things a couple of things I want to let you know about that. Number one, when I pull your credit as a mortgage lender, there are certain things on your credit that mean more to me than if a car dealership was going to pull your credit, or even a credit card company was going to pull your credit. For instance, if I pull your credit and I see a lot of high balance recurring credit, meaning recurring is like a credit card. There's two types. There's recurring and there's installment. Installment would be like a car payment. You're making the same payment every month. Recurring is like a credit card. Credit goes up, credit goes down. So if I see that you have a lot of high balances on a lot of recurring credit, that's going to mean more to me than, say, a credit card company or even a car dealer. So that's why you end up getting so many different scores from different places. And then you add in, there's 3 credit bureaus who also look at things differently. That's why you get 3 different credit scores. So it can be a bit confusing, I understand, but just understand that if you're looking at Credit Karma and you're seeing, hey, I got 780 as a credit score, there's probably a pretty good chance that when you pull credit from a mortgage lender, that score is going to be a little bit lower, because your credit card companies and your Credit Karmas, they're looking at you with the best possible situation to give you the highest credit score possible. Now, I'm not saying that if you look at those that they're wrong. I'm just saying that you have to understand that different things, different people or different companies are going to look at credit differently. I will tell you that the good part about Credit Karma and those other things is to watch your credit, to make sure that things that are on there should be there. It's a great tool for monitoring your credit, because you don't want things on there that shouldn't be. I will also tell you that on this screen, you can see where it says in red, annualcreditreport.com. So this is really what I suggest if you want to watch your credit. This does not give credit scores, but it gives you everything that's on your credit. And it's free. There's no charge. And each credit bureau allows you to pull your credit from annualcreditreport.com for free 1 time a year. And so what I do is, every 4 months, I'll pull Experian, and then the next 4 months I'll pull TransUnion, and then the next 4 months I'll pull Equifax. So all throughout the year, I'm pulling these. And when you're checking your credit to make sure that there aren't things there, one bureau versus the next is going to be pretty darn close. And that's why I do one throughout the year, because that way I can watch it throughout the year. I'm going to go to the next screen here. So these are the 3 credit bureaus that you have. And those numbers next to them are their telephone numbers. So if you have something on there that you're looking at your credit report or your creditreport.com or Credit Karma, and you're like, wait a minute, I don't have a Macy's card. TransUnion has me having a Macy's card. You can call TransUnion and say, hey, I don't have this Macy's card. I don't know how this is here. And so then they will tell you either how to dispute it, or they can dispute it as well. Or the same thing if there's a bad charge, or if there's, a lot of things show up on your credit that shouldn't be there from time to time. And so these are the numbers that you can call, and you can find out, hey, is this something that, how do I take care of getting this off of there? A lot of times they'll do it when you say, hey, I'm disputing this, and then they go out to the merchant to make sure that it's a good charge or not. Sometimes you might have to do a little homework yourself and maybe write a letter or two to somebody to get that done. But it's a good place to start. So credit scores, for mortgage lending, everybody says that, I don't want you to pull my credit because it's going to hurt my credit score.
Your dad needs to pick you up.
That's true to a point. It does hurt your credit score a little bit if there's a lot of inquiries, but if you pull credit from 3 or 4 mortgage lenders, but all within about 2 or 3 weeks, the credit bureaus understand that you're looking for a loan, and so they only hit you, quote unquote, hit you one time for those inquiries. It's not like they hit you every time. It's the same thing if you go to a car and you're looking for a car deal, and Ford pulls your credit, and Chevy pulls your credit, and Subaru pulls your credit. The credit bureaus understand, okay, this person is looking for a car, so they're not going to hit you for every one as long as it's done within a rather short period of time. And also with credit, and especially when it comes to, the reason why lenders pull your credit, most people think it's to check your credit score, and that is true. I'm not saying that's not true, but the biggest reason why we pull your credit is to see what debts you have, because we need to look at your debts versus your income when it comes to qualification. And so it's actually a lot more important to check the amount of debts that you have rather than the scores. And a couple things about scores. Number one, scores are done when it comes to pulling your credit as far as scores are concerned. We look at your scores to judge or to see how much in interest you're going to pay for that loan. So bad credit score, you're going to pay a little bit higher in interest. Low credit score, you'll pay a little bit lower in interest. Because it goes by risk. A higher credit score means you don't have as much risk versus a lower credit score where you don't have, you might have a little bit more risk. So if that's the case, then we're going to go ahead and and charge you a little bit more on interest. But it also goes in buckets, meaning that we look at credit scores from 681, all the way down to 6, but I'll just say 681 to 700, 701 to 720, 721, and on up. So my point is that if we pull your credit and you're at 719, and then somebody else pulls your credit and you drop all the way down to 702, your interest is going to be the same because you're in that bucket. Whereas, and I know this isn't particularly fair, but it's true, if you have a 701 and somebody pulls your credit and it drops down to 699, you're actually going to be paying a little bit higher in interest because you've moved in that bucket. So that's another thing about credit. So, and then thirdly, or the other thing is, again, it's way more important that we look at your debts versus what your score is, because the difference in rate between 4.125 and 4.5, or even nowadays 3.5, your monthly payment's not going to be that different. And what I always tell people is, again, we want to see what debts you have versus your credit score, because if there's somebody out there that's making $100,000 a month and they have a credit score of 600, I'm probably going to be able to get them a loan. Whereas if somebody has a credit score of 800, but they're only making $1,000 a month, that's going to be tough to get them a loan, because it's the qualification that comes in. It's that debt to income ratio. We'll get to that in a little bit, but that's a bigger part of credit rather than what the actual score is. And the reason why I go into so much depth here is I want to get rid of the myth of I can't buy a house because I have bad credit. That's not true at all. It couldn't be further from the truth. Yeah, you may pay a little bit higher in interest rate, but that shouldn't stop you from at least going down and finding out for sure, because your income versus your debt has way more bearing on your qualification than your credit score. And so I know that there's a lot of people that walk around here, and saying, oh, I can't get a house, I got bad credit. That's not true. And so I want to get rid of that myth that because it's just not true. And I hear it all of the time. Yes, if you have a bankruptcy, yeah, we might have to do a little thing. If you have a foreclosure, sure, we might have to work around it a little bit. But trust me, talk to a mortgage professional, even if you think you have bad credit. And then also, your credit may not be as bad as you think. All right, so those are a couple things, as far as credit goes. So when it comes down to understanding your financial picture, this is kind of where we're going to start getting into the debt to income ratio that is so important when it comes to qualification. Because as a lender, and most lenders out here kind of follow pretty much the same variables when it comes to debt to income ratios, we like to see your debt to income ratio at 50% or lower. Meaning, you make $10,000 a month, we don't want to see your debts more than $5,000 a month. And that $5,000 will include the new payment that you will have for your home, your principal and interest, property taxes and insurance, sometimes mortgage insurance as well. So it's how much you make versus what your debts are, your credit card debt, your car debt, your if you have student loans. Now, things that aren't on there that are, like your cell phone, that's not going to come up. Some smaller credit cards that are like a furniture place might not show up there. Because those are things like, especially like cell phone. I know this is going to sound crazy, and I hope nobody falls out of their chair, but technically you don't have to have a cell phone. Okay, so that's why we don't count that as part of your debts. Whereas a credit card, I know you don't have to have a credit card, but if you do, you have to make those payments. If you have a car, you have to make those payments. Whereas a cell phone, you technically can just stop making payments anytime you want. So that's why we kind of take a look at that. The other thing is making a list of all of your debts, right? And let's go to this page. This is one of the reasons. This page right here is actually this page, and I think the next page is one of the reasons why I really think it's important to get this presentation, because when you start looking at this stuff and you start writing it down, it is amazing how much you realize you're spending on Starbucks coffee and how much you're spending on going out to, although we're not going out to lunch right now, but if we were, how much you spend on things like that. And when you're trying to save to buy a house, it's really important to look at this whole picture to see exactly where you are and see exactly how much you can save versus what what the debts that you have to pay. So this next page is also, so like the spending. This is the one that, how do I go back? I gotta go back. Hold on a second. I gotta figure out how to go back. Oh boy, I'm going the wrong way. Hold on a second here, guys. Just give me 1 second.
David, looks like it's the bottom left corner of your screen. There's a little.
Oh, here it is.
Yes, perfect.
I'm an old guy. I can't see things very well anymore. Okay, spending. So this is the page that I really want everybody to kind of think about. And again, even if you don't get the presentation, it's something that you should probably do. Writing down the amount that you're spending, especially in that non-essential area, because that's where you're like, okay, maybe I should be taking my lunch to work. Maybe I can just go ahead and drink the coffee at work rather than Starbucks. Maybe I don't need to go out as often as I'm going out. Things like that. You'd be surprised how quickly that kind of stuff adds up. And again, when you're saving for a house, every nickel and dime will count. And so it's really important to go through this stuff and see exactly where you stand. It's very, very helpful. It's very, very eye-opening. And it's something that you really should be taking a very close look at in this situation. So now, selecting a mortgage professional and getting pre-approved. Well, selecting a mortgage professional, that's easy. I'm right here. I'm here for all of you. We partner with South Bay Credit Union. We've been partners with them for a long time, and I'd be more than happy to help out with any questions you have. But that being said, South Bay Credit Union does a great job lending, and you might know your sister's boyfriend's friend is a loan officer, or this person. So what I really want you to take away from this is talk to a mortgage professional about your questions, because they can point you in the right direction. There's a lot of them out here. and it's very, very important. But the biggest important thing that I want everybody to think about is getting pre-approved. That I cannot tell you how important it is to get pre-approved for two reasons. One of the reasons, and mostly the biggest reason right now, is if you are in the position to start looking for a home, realtors won't even look at you if you're not pre-approved, because they're getting plenty of people who are pre-approved. If you don't have that pre-approval with you, you're not even going to be in the conversation. And so it's very, very important to get pre-approved. But the other reason, and I think more important for what we're talking about here, is let's find out where you stand. Let's see how close you are to being able to buy a house. If you don't get pre-approved, you don't know for sure. And that's what is so important, is to know for sure where you stand, so that I can tell you, listen, you're real close to being where you need to be. If you pay off this credit card, or maybe next time you lease a car, don't lease a car so expensive, or drop this debt down, you can be in a great position. And a lot of times there's also things like, a lot of people will think, well, I got to get rid of my debt for the pre-approval, to buy a home. And sometimes that's true, but sometimes it's not, because if your debt to income ratio is kind of where it should be, then we don't need to pay off any more debt, and maybe you can use that more for a down payment. So again, people don't know for sure, and we have to make sure that and getting pre-approved is how we put you on the path to get there. Now, I will tell you, and this is true as I can make it, I've been doing these home buying seminars for over 3 years. I tell people all the time to get pre-approved. Getting pre-approved is free. It doesn't cost you anything. And more importantly, it doesn't cost me anything. So it's completely free to do. And so there's no reason not to do it. And I've done a total of 5 in the last 3 years that I've been doing this. I understand people say, I don't want to have to go through this, or I'm not even close, I don't even want to bother. It's not a bother, and you might be closer than you think. There might be a couple of tweaks here and there that we can get to where we need to be. With the programs that are out there, you can put as little as 3.5% down. And a lot of times, that's just enough. And we'll get to that in a little bit. But I'm going to say it again. Please get pre-approved. Whether it's with me or another mortgage professional, please get pre-approved. And also understand, there's a difference between getting pre-approved, like I call it, or getting pre-qualified. Getting pre-qualified is when you're talking to somebody on the phone and they say, how much do you make? What kind of debts do you have? Okay, how much do you have for a down payment? Okay, you can probably afford this. That's just having a conversation. That's getting pre-qualified. Getting pre-approved is when you send your documents in, when I'm going to run your credit, when I'm going to send those files to our underwriter so they can tell me this person is pre-approved for this number. And that's how you know for sure you're pre-approved. And I will also tell you, I almost guarantee you, I can pre-approve everybody on this call right now. Here's the thing. It may not be an approved for what the amount that you want, but I guarantee you I can pre-approve you, because it always comes down to a debt to income ratio. How much money do you make? How much debts do you have? It'll show us a number that you're pre-approved for. So again, maybe it's $150,000. Maybe it's $550,000. We don't know until we do a pre-approval. And so that's why it's so important. So are there any questions yet?
David, yeah, we do actually have one question. Sonia asked, does a pre-approval ding my credit score?
So it will ding your credit score when we pull your credit, yes. But again, sometimes you'd be surprised. It doesn't hit it that hard, because so your credit score is made up of a couple of things. It's made up of your payment history is about 35%. Your balances is a percentage. Your history of credit, and then your inquiries. Now, inquiries are when somebody pulls your credit. So it is, but it's only about 10% of your total credit score. So it really doesn't hit it that much. So it's really, your payment history, your balances, and the amount of time that you've had credit is way more important on your credit score than somebody pulling your credit. Okay, and again, like I was talking about before, if you don't move within one of those buckets, then it really doesn't matter if somebody pulls your credit anyway. So I would not let that stop you from getting pre-approved. I don't think it's really going to, it's not going to change that much. Is there any other questions right now?
Not at this time. Thank you, David.
Okay, so let's continue on. So let's first talk about the area on the left, the documents checklist, okay? So this is what you basically need for pre-approval. And it's really not that much. 2 years of W-2s, 2 years of tax returns. I always say 2 pay stubs because it's usually people get paid twice a month and we need it for 30 days. And 2 months of your bank accounts, right? So it's really just, you know, your W-2s and your taxes are usually together, so they're pretty easy to find. Your pay stubs, obviously, nowadays, everything pretty much comes online, and your bank statements are pretty much online too. So it really is not that, everybody thinks it's a big, you know, horrible process of pulling all of this information together. And when you really think about it, the amount of stuff that's online now, it's really pretty easy to pull together. And then also, when you do a pre-approval, I'll use, for me as example, I have a link that you can send things to me completely safe. They come over encrypted and like I said, 100% safe. So if you, when you do a pre-approval, if it's not with me, please make sure whoever it is that you're doing that pre-approval has a secure link that you can send that information over, because you don't want to be sending that stuff over email. I mean, let me tell you something, I'm a great guy, but I can't control what comes over on email. So you want to make sure you have that that secure link, whether it's me or, and I will tell you, most lenders right now have them, so there's no reason not to. And they're usually very, very easy to use. If you just scan the documents in, you just drag and drop it, and it comes over to, like on mine, it comes over to me directly. So please make sure that you use that. Now, researching first-time buyer programs. So there's a couple of things here that I want to touch upon, and that is, first of all, first-time buyer programs, what that really means is that the lender that you're dealing with has the ability to use an FHA program. We have to be licensed with FHA to be able to use their programs. And an FHA program, what that means is you can put as little as 3.5% down. So if you're buying a, you know, $500,000 house, you're talking about, you know, about $17,000 down with closing costs, which is not part of the down payment. It's a little, so it'll probably be another, you know, $10,000 somewhere in there. So, you know, for a $500,000 house, you basically, you know, with about $25,000 in cash, there's a good chance that you can qualify for a home. So that's what an FHA program. Now, the good news is FHA, again, you're putting a smaller down payment. That's great. The interest rates on FHA are actually a little bit better than normal interest rates. And if you do have challenging credit, they tend to have better rates for that as well. So those three things really help people as far as home ownership goes. The other side of that coin, because there's always another side of a coin, is mortgage insurance. So let's talk about that for just a moment before we get into the rest of these programs. With mortgage insurance, anytime you put less than 20% down with any program, whether it's FHA or conventional or jumbo, any program, if you put less than 20% down, you have to pay mortgage insurance. Now, let's talk about FHA. With FHA, mortgage insurance is usually a little bit higher, and you have to pay it for the life of the loan. That means as long as you have that FHA loan, you have to pay mortgage insurance. Let's talk about conventional loans. If you put less than 20% down, you're paying mortgage insurance. But once you reach that 20% equity in your property, whether it be through just making your payments, because every time you make a payment, part of it goes to principal, and so that loan to value is going to go up. That'll help. The other thing is appreciation, right? You buy a house for $500,000. In 2 years, that house is worth $575,000. And I'm just throwing numbers out, but that's another way that your equity continues to build in your home, getting you to that 20%. In a conventional loan, Once you reach 20%, you can call up your lender and you can say, hey, I'm at 20%. Can you please remove the mortgage insurance? What will have to happen is you'll have to get an appraisal. They usually cost about $500, but a lot of times it's worth it, because if you're paying $225 in mortgage insurance and you get a appraisal and now you can get that thing removed, well, your break even is 2 months. So it kind of makes sense to do it. But again, with FHA, you're paying it for the life of the loan. Now, in an FHA loan, and we do this all the time, I have people that they got an FHA loan about 4 or 5 years ago. They call me up. They say, hey, I think I'm at 20% now. We take a look at their numbers. It says, yep, looks like you're probably pretty close to 20%. We can then refinance them into a conventional loan. Now, yes, it costs a little money to do a refinance, sure. But a lot of times, again, if you're getting rid of that $250 a month payment, if you can break even in a couple years, then it makes sense to do it. So that's where mortgage insurance kind of on FHA. Again, I always tell people, if you're renting, your next best step is FHA, right? If you have to get into an FHA loan, don't not get an FHA loan because you have to pay mortgage insurance. Buying a home is way, way, way better than not buying a home. If you can get conventional, that's even better, right? So when I'm talking to somebody, the first thing I look at is this possible to do a conventional loan? If it is, great, because with conventional, you can put as little as 5% down. We even have some programs where you can put as little as 3% down. So there are conventional loans out there that you don't have to put as much down, but if you have a little challenging credit, then maybe we go FHA. Or maybe the interest rate's a little bit better, but I would always try and get somebody into conventional first. If I can't, then I go FHA. Okay, so FHA is a great program for home ownership because of the benefits of home ownership. We're talking about you get appreciation of a home. You get to write off the mortgage insurance, or I'm sorry, the mortgage interest. So those are two things that right there are great for you. So now that I've gone into the weeds on that a little bit, let's talk about first-time homebuyer programs. So again, you have FHA. Other things that are out there, you have down payment assistance programs. You have grants that help you with closing costs and down payments. And then also you have reduced lender fees depending on loan programs. So let me break that down for you really. There are a lot of people talk about down payment assistance programs and what we have out here. And yes, we do have down payment assistance programs in most of our areas. It's basically by county. So LA County, Orange County, San Bernardino County, all our counties have these down payment assistance programs. But here's again, we got two sides of a coin. Yes, they're great. They can help you. I think most of them go up to 3% of the sale price you can use as a down payment, which is great. The other side of that coin is there are income restrictions, meaning you can only make up to a certain amount to be able to use these programs. Now, more times than not, that it's what's called the median income of the area of which you live in. So right now, I think those numbers are for a single person. You can't make more than about $65,000 or $67,000 to use these programs. As a married couple, or as a couple, we're not married, but as a couple, I believe you're only up to $107,000, which is fine, but now we got to talk about qualification. A lot of times it's kind of difficult to qualify for homes at the values of where we live to be able to use these programs. So I don't want to sound like a Debbie Downer here, but I want people to understand down payment assistance programs work great in Boise, Idaho, where homes are $200,000. In Southern California, where homes average around $500,000 to $550,000, sometimes these down payment assistance programs can be a little difficult to find and use. Now, you get out into the outer areas of San Bernardino and I'm in Santa Clarita, so Lancaster, Palmdale. There's some, now, in the Inland Valley, there's, Palm Springs, that kind of area. You can find some homes that really work, and we have a couple loan officers in those areas, and they do use them. So, but a lot of people, they hear down payment assistance, oh, that's great, but then it has that, oh, well, you make too much, you can't use it, or you can, but you can't qualify for the home in your area. So that's all something that we talk about in our pre-approval. Again, back to why you need to get a pre-approval. Now, if you can use these programs, that's fantastic. They are great and they are really helpful. The two types of programs that you'll see is where it says the grants to help with closing costs, down payments. A grant is great because you don't have to pay it back. So that's wonderful. They do have things, they're called, you'll hear them as a silent second. And what that means is they're going to give you, I'm just throwing a number out here, $20,000 for your down payment that you can use for down payment. And that is actually a loan that they put, we call it on the back side of your mortgage, meaning that loan sits there, that $20,000 is sitting there, it stays there until you sell the home or you refinance the home. We have to pay that back at that time. But a lot of times, you're starting an FHA program, you've gotten to where you're at 20% equity. Now paying off that other loan is not that big a deal. We just wrap that into the refinance when we're getting rid of the mortgage insurance, and we're getting rid of that as well because we're now getting a new loan with those parameters in there. So, so again, with down payment assistance, they're great, but they can be a little challenging from time to time. So again, any questions yet?
Yeah, David, we actually do. So one of the statements or questions was, can we expand a little bit on what FHA and a conventional loan is? And also, real quick, Matt had asked, does it make sense to get pre-approved by multiple mortgage companies to compete on rates?
Okay, so let's talk about the getting pre-approved with more. No, you should only get pre-approved with me and nobody else because I'm great. So that pretty much sets that aside. No, of course, to answer your question, yes, you can do that. Most pre-approvals from most lenders are going to be about the same. And one of the reasons why I talk to you about getting a pre-approved is more about talking about down payment, talking about debt to income ratios, what you qualify for and things like that, rather than rate. Like when I'm doing a pre-approval, I put in a rate that's higher than what the market is because I like to be conservative. And if somebody's not ready to buy a home now, I'm going to pick a higher rate just in case down the road. When you're getting approved for it, or you're really ready to start looking, yes, I would talk to a couple lenders. You can talk to a couple lenders about rate. That's when rate really comes into play. On a pre-approval, it's really more about finding out what you can afford, and most lenders are going to be about the same. So getting a pre-approval with one lender versus getting pre-approved with another, like I said, unless you're really close to buying a home, I don't know that that's necessary. Like, I'll tell you a perfect example. Somebody called me and said they were pre-approved with another lender and they wanted to know what my pre-approval was. And I said, listen, I can do the pre-approval for you. I won't run your credit because if you already had your credit run, you can just tell me what's on there. And it came out almost exactly the same because, and this is probably more information than people want right now, but I'll tell you, most lenders, myself included, sell our loans to Fannie Mae and Freddie Mac, the government entities. And the reason why we do that is two things. Number one, the government kind of wants us to do that because they don't want mortgage companies having all these loans on their books, because in 2008, when we had the meltdown, a lot of mortgage companies went out of business because they had the mortgages on their books. So we get them off of our books. So that's why most pre-approvals are pretty much the same, because we're all going to those guidelines that Fannie Mae and Freddie Mac put out there saying, we'll buy your loans as long as it meets this criteria. And so all of us lenders have that same criteria. So that's why I'm saying, getting a pre-approved from different lenders, to find out what you can afford, probably not the best thing. If you're ready to move, then yeah, I would definitely talk to a couple of lenders and see what they have out there and what they can do. So, and then the other question, the FHA versus conventional. Again, FHA is the government program, and it just basically it allows for lower down payments, whereas a conventional loan, they're pretty much the same. Like I said, I would always look at conventional first because you can get rid of the mortgage. It's the mortgage insurance that makes the biggest difference when it comes to conventional versus FHA. And the biggest difference is that FHA, the mortgage insurance, is there for the life of the loan, whereas conventional, it's not. With a conventional, like we talked about with FHA, you have to refinance into a conventional loan to get rid of the mortgage insurance. On a conventional loan, that's when you can just call up your mortgage company and say, hey, get rid of my mortgage insurance. So that's really the biggest difference. Did that answer the question?
Yeah, that was great. We do have one more question.
Sure.
what if I keep the home forever? Do I still have to pay the silent loan?
You know, that's a good question. I don't think so. I think it's only if you sell or I think it's only if you sell or refinance the loan. I think that's the only time you have to pay that loan back. So I mean, I'd have to look into that, but I'm pretty sure. I'll tell you, yeah, it's more times than not, people are either refinancing or the rule is, or the statistic is that people refinance or buy or move every 7 years, and so yeah, I would say that loan is probably only pay, like I said, only if you live in the home forever. I do not think you have to pay that loan back. That's the answer, but I would have to, you'd have to look into it, and different ones are handled different ways. So you'd have to look at, I would, if you do that, make sure that your mortgage professional goes over that with you, you know, line by line, to make sure you understand what you're getting into. Okay, is that it for now? Or any more questions for now?
Looks like we have one more. How
Okay.
are closing costs paid? Are they put into your monthly payment, or are they upfront cash like your down payment?
So closing costs when you're purchasing a home are paid up front. They're not put into the loan. So that, and the rule of thumb is your closing costs are about 2% of your sale price of your loan. So, you know, you're buying a house that's $500,000, your closing costs are going to be about 10 grand. So that's a rule of thumb. That's not by all true, but that's kind of what you can, if you're, you know, doing, you know, back of the envelope kind of math, that's where it is. But again, when you're purchasing a home, that has to be paid up front. That's why I'd say, you know, people need to understand there's a difference between down payment and closing costs. Okay, they're not the same thing. So when somebody says, oh, your down payment is, you know, $20,000, you're still gonna, there is the money that you need to bring in, how we talk about it. So your down payment is, you know, $25,000, but your closing costs are another $10,000. You need to bring in $35,000. Okay, so they are separate. Now, just again, I like to get in the weeds a lot. On a refinance, okay, so we're refinancing that loan. If you're doing a refinance, the closing costs you can add to the loan. So you have your outstanding loan balance is $250,000. Your closing costs on a refinance, your closing costs are less than a purchase because there's more things that you have to pay for on a purchase. Your closing costs on a refinance a little bit less. So your outstanding loan balance is $250,000. Okay, well, we do a loan for $255,000, so that covers those closing costs. So on those types of things, you don't have anything out of pocket. So that's kind of where the difference is. But purchase, got to pay up front. Refinance, you can finance those closing costs. Does that answer the question? Yes? Okay.
Looks like it did.
All right.
Yeah, thank you.
Okay, perfect. So we shall move on. Choose the best mortgage. How come this keeps happening to me? Choose the best loan. Okay, so we kind of went over this a little bit. Let's talk. There's FHA loan programs, is pretty straightforward. VA is a great program for any veterans out there, or I believe spouses of veterans. It is a fantastic program because there is no down payment. You don't have to put anything down, right? And VA, there's eligibility that you have as far as being in either the active military or the forced services of the military versus being a National Guard is a little bit different. But if you are in any of those, you have to check out a VA loan. So many people I talk to that are veterans don't know the benefits that they get, not only in lending, but in general. And there are a lot of benefits out there for our veterans. So make sure if you are a veteran, ask the question about what program you can use, because it is great. Once you get rid, the two things that are great about VA loans, again, no down payment. Now you still have closing costs, all right? Because remember, they're separate, but even your closing costs are less because there's certain things on a VA loan that the veteran cannot pay for. Also, rates are pretty good on VA loans, or even a little bit better. So sometimes you can use what's called lender credits to even pay for more of those closing costs, and you can get into a home for almost nothing. So it really, really is so important to, if you are a veteran, talk to a mortgage professional about a VA loan, because it is, I'm telling you, it is a great program to look at. So FHA loans, wonderful for home ownership. VA loans, great. USDA loans, because it's on here, I'll tell you, yeah, they're great too, but they're really only for rural areas. So it's like you got to be in, I don't know, Fresno or Bakersfield, or I don't know, some of it to be able to, but there are regions that you can use them, and they basically are kind of the same as a VA loan in that there's no down payment. So that's good, but again, they're pretty far. You have to be pretty rural to be able to use those programs. And then here's the, we talked about conforming conventional loans. So that's like about what we were talking about, VA versus conventional. Conforming means that there are, in Los Angeles County, and I think in Orange County, because I know you guys are down there, there are 3 levels of loans. There is the conforming, which means that your loan balance is less than $510,400. It's the U.S. government. That's why we can't just have a round number, because that would be way too easy. So $510,400 if your loan balance is below there. Now again, that's not the sale price. So if you're buying a house that's just $600,000 and you're putting $100,000 down, you're in that conforming range because your loan balance is below that number. So that's conforming. Now you have high balance. High balance is anything from $510,400 up to, are you ready for this? $726,100 is jumbo. So we have high balance is between there, and then we have jumbo, which is anything over $500 or $726,000. So that's all. That's just what conforming means, just because you'll hear conforming, but what's more important is the conventional part of it. Conventional just means a regular, straight 30-year fixed, 15-year fixed. Those are, so that's what you're talking about when you're talking about conventional. Conforming is just the loan number. Then you have jumbo. So again, jumbo is a little bit different in that jumbo, we talked about all those loans being sold to Fannie Mae and Freddie Mac. Well, these jumbo loans are sold to investors. They're not sold to the government agencies. And so jumbo loans have a bunch of investors. Like here at American Family Funding, we have about 19 jumbo investors. So they have different criteria for the loans that they're going to buy. It's pretty much the same, but one might have one thing and another have another. So, but with the jumbo, that's why you get into this a little bit different, because there's different areas of it. So so with jumbo, it's just you talk to different investors. Interest-only loans, they were bigger back, before the crash, before the meltdown. There are really not that many out there anymore. And to be honest with you, the interest rates aren't that great on, because nobody really wants to do interest only anymore. Everybody pretty much is that 30-year and 15-year fix is really the loans that everybody wants to do. But I do want to talk to you for a moment about fixed rate versus adjustable rate mortgages, because I do think that they're worth talking about. A lot of people get scared when I don't want an adjustable rate. And trust me, with interest rates where they are right now, I hear you. I'm with you. Getting a fixed rate right now is absolutely the best thing. But adjustable rate mortgages, you will hear the term sometime ARM loans. You'll hear 10-1 ARM, 7-1 ARM, 5-1 ARM. That means adjustable rate mortgages. The rates on these are even lower than what the regular rate is now. So let's talk about a 10-1 ARM for example. 10-1 ARM means that the rate stays fixed for 10 years before it starts to adjust, right? So 10 years, it's at 3%. And then year 11, it can adjust to whatever the interest rate is in the marketplace. Now, the other good part about the adjustable rate is there's caps, meaning there's a 2% cap. It can't move more than 2% any adjustment period. So in year 11, you're paying 3% and interest rates are at 7. Well, you can only go up to 5. Because it can only move 2%. Next year, they're still at 7. Okay, now you can go to 7. Same thing going down, though. It can only go down 2%. But there's also a lifetime cap on it, meaning if you get a 3% rate right now, most of the caps on adjustable rate mortgages are 5%. So the most you can ever pay is 8%. Now people say, oh my God, that's so high. How can it be? You must be kidding me. Why would I want to do that? Well, I would tell you, Google, interest rates for the last 30 years and see where 8% comes in. When I bought my house 20 years ago, I paid 11% and I thought I was a hero. So I know it sounds high now, but it's not terrible when you look at how rates are over the last 30 years. Now, let's talk about where an adjustable rate mortgage kind of makes sense. Let's say that this is this is going to be your starter home, that this is going to be the home that you're going to live in for probably 5 to 7 years. You're buying a little condo somewhere for $350,000, and you're like, you know what, I want to get into home ownership. I want to start building my wealth. This is the way I'm going to do it. But I know that I'm going to be moving in 5 years because that's my plan. Well, an adjustable rate mortgage might not be a bad idea, because if it stays fixed for 10 years and you're going to move in 5 to 6 years, why not pay a lower interest rate? Kind of makes sense. So there are times when they can make sense. I'm not saying you should do it. Fixed rates right now, interest rates being so low, absolutely the way to go. But don't, not look at an adjustable rate just because people hear the term adjustable and they're like, forget it, I don't want to do it. There are times when it can work. Okay, so not every time, but there are times we should at least have the discussion about it. And again, that's when we're talking about a pre-approval. That's one of the things we talk about in a pre-approval. So that's, again, I'm going to keep coming back on this pre-approval. I don't know if you've noticed, it's kind of a theme all of a sudden, but it's definitely something that we at least should have a discussion about. I'm not saying we should do it, but at least have the discussion. So, do you need mortgage insurance? So yep.
David, we have a few questions real quick if I can
Sure.
jump in. One of the questions was going back on mortgage insurance, are you able to apply that to your loan?
Well, yes, kind of. So actually, this is a good page to have that discussion. Here are the different types of mortgage insurance that are out there. Borrower paid monthly premium. This is what 90% of the people do, is they just pay for it as part of their monthly payment. And it's figured in the monthly payment. Borrower pay single premium. Okay, so this is where we're talking about maybe you don't really, it's not really part of the loan, but you can kind of finance it. Okay, so, but again, if you do this, you have to look at how much you're paying and when are you planning on moving, and does it make sense? Because if you do this and you might refinance in 5 years or move in 5 years, might not be a great idea, because this number is pretty big. Usually it's pretty big. It's, $15,000 or something, $12,000. So by the time that it makes sense to do the monthly versus making the single payment, if you're going to be like, again, if you're going to stay in the house forever, sure, it might not be a bad idea. But if you're not, or if you have any question, I would probably stick to the monthly, because you don't want to pay for a bunch of stuff and then either refinance and move, because then you lose out on that money that you paid. Lender paid. So lender paid this is more of the kind of quote unquote putting it in the loan, because what happens here is I, as a lender, I'll pay that $15,000, but your interest rate's going to be higher. So that's basically how it works. So instead of 3.5%, maybe 3.5%, we look at, all right, well, to get that premium, to get that number of $11,000, you're probably going to end up paying, instead of 3.5%, maybe as high as 4%, maybe a little even higher than that. So you can do it, but I don't advise it, because over the long run, you're going to end up paying more than if you just did the monthly. So that's so I really think when it comes to mortgage insurance, I like doing the monthly. I think that's the best way to do it, but we can have the conversation and we can run the numbers and see where it all comes out. And where we run those numbers? Yeah, that's right, in the pre-approval. You had some other questions?
Yeah, I have one more. Can property taxes be calculated in the monthly payments?
Okay, so yes, that is, let's talk about that for a minute. So when you're making your payment, when you're making your mortgage payment, everybody says, oh, I'm making my mortgage payment. It's really, it's the first mortgage payment. The first piece of the mortgage payment is your principal and interest. Okay, so principal and interest is exactly that. You're paying your principal, you're paying the $500,000 loan, plus you're paying the interest, the 3.5%. That is your principal and interest. That's the first part of it. Now, there are other parts. There is your insurance. Now, not mortgage insurance. This is insurance. Your fire, your flood, your, something you run into your garage with your car insurance. And yes, I bring that up because I ran into my garage with my car. Yes, it happened. So this is the insurance that we're talking about. So that's something that has to be paid. Now, you can either pay it yourself on your own, or you can make it part of your mortgage payment. Property taxes, same thing. They have to be paid. You can pay them on your own, or you can make them part of your mortgage payment. Now, when you do that, it's called impounding those payments. You're making one payment with your mortgage. And then what will happen is the servicer that you use, whoever's has your mortgage, the person that sends your statements and collects it, they will pay your insurance every year when it's due, and they'll make your property taxes payments when they're due. They're due twice a year, in March and November. Because again, the government, it can't be 6 months apart. No, that would be stupid. So twice a year you make the property taxes and insurance. So it's your choice. You can either impound it and make it part of your payment or not. It doesn't, the numbers are the same. It's all personal preference. Me, myself, I pay them myself just because that's who I am. That's the kind of guy. Again, it's 6 to 1, half a dozen the other. It doesn't cost more to do it. It doesn't cost less not to do it. So it just depends on how you want to do it. Most people would impound them just because that way they don't have to think about it. They don't have to worry about it. Back in the old days when interest rates were a lot higher for savings accounts, people would say, oh, I'm not giving the government money until I have to, and so I'm going to get the interest on that money. Well, right now, interest on that money is nothing. So it just depends on what you want to do. It really, there's no advantage or disadvantage to doing it. Let me back up. As long as you're disciplined with your finances and you can set aside that money that needs to be set aside for those things, then there's really no disadvantage or advantage to doing it. So, but you have to be, like, for me, I have a separate savings account. I put money in that savings account. So when my property taxes and insurance are due, I just make the payment out of there. But again, that's just my thing. So, but yes, so when you make it part of your mortgage payment, that's called impounding. So, and it depends on how you want to do it. So, anything else right now?
No, that's all for right now. Thank you, David.
Okay. So now is when you really kind of come to the point where we let those real estate agents get involved. This is what, so you got your pre-approval. You kind of know what you're looking for. Now you want to talk to a real estate agent. And when you're talking to a real estate agent, the reason why you want to do that, and again, I cannot tell you how important it is to use a real estate agent. I know there's these Zillows and Redfins and all this kind of stuff, and people go, oh, you can buy some. There's so many contracts and so much going on with this purchase, and these real estate agents, they know the market, and you want to have somebody working on your behalf, fighting for you to get the best deal possible. And the really important thing to realize, and not a lot of people realize this, is when you're buying a home, the real estate agent is paid by the seller. So you're not even paying that person. So that person is working for you, trying to get you the best deal possible, but they're getting paid by, so you don't have to pay them. So again, I kind of go back to, you really need to talk to a real estate agent. Plus, they'll tell you, yes, this makes sense. No, this doesn't make sense. They'll find things out there, tell them what you want. Tell them everything. There's a big difference between what you want and what you need, but you got to tell them everything. Tell them everything you possibly can, because that way they can go out and find the home that's best for you. So I have a lot of real estate friends. I deal with real estate agents daily. And so if you have some questions, I'm happy to refer somebody to you. Everybody I talk to is great, but you have to use one. Don't think you can do this on your own. Trust me, I didn't. All my loan officers here, nobody has gone out and bought homes. We've all used real estate agents, and we're in the business. But there's so much involved that you have to use a realtor. So that's kind of my pitch for that. So this is kind of making your wish list and kind of going from there. We do have, I mean, so I'll talk to you more about, this is just in case. This doesn't really happen very much anymore. But we have what's called a dream home renovation program, which means that if you're thinking about buying a fixer-upper, that you can, there is a program out there where we can give you, we basically give you a loan based on what the value of the home's going to be. But to do it, you have to have a contractor, you have to have them give you an official bid, and that, so it can be a little difficult to use, but they are out there. But I'll tell you, more times than not, these programs, nobody's using these programs really anymore, because most of the homes out here are pretty much kind of new, or the inventory is so low. So they're not, but they are out there, and it's something you can definitely talk to because some lenders might not do them. We do, but we have to, it gets, pretty far in the weeds on what we need to do for it. So, and I think that's kind of it. We're right at that 7 o'clock number. So I'm happy to hang out and answer any more questions if you'd like. If you want me to go back to a certain slide so we can talk to that now that I know how to go back, we can definitely talk about a different slide, or if you want something else, or let me know. I'm here to answer any of your questions.
If anybody has any additional questions, feel free to unmute yourself and have at it.
And I'll stop the share. Oh no, I'll leave it on here. Anybody? Don't be shy.
I don't know.
What's these days thinking about how much house one can afford?
I'm sorry, say that again?
How much house one can afford? I guess the thinking about it kind of changes over time, and used to be 3 times your income. What is it these days? Because there's so much stuff out there, so many different programs out there and so many different things, it really kind of comes down to the debt to income ratio. So the way that you kind of, again, back of the envelope kind of thing is you look at your income and then you look at all of your debts. And again, we want to be 50% of what your income is. So, and when it comes to income though, I did forget to mention this, we go by your gross income, not your take home. So, take out the insurance, take out the 401k, whatever your gross income, that's the income that we're looking at. So if you're making $6,000 a month, then then your debts need to be $3,000 or lower. What I would do is, again, I would go back to this page to kind of show your financial pictures, how much you're spending, what your debts are, and then I would find a mortgage calculator. So if you go to our website, AFFloans.com, we have a mortgage calculator on there. I also have an app that if you want to, I can provide you that information. It's a great calculator because it has not only your principal and interest, your insurance, and your property taxes fields on there. It also has HOA, because if you're buying a condo, you got to work in that HOA as part of your debts. It also has mortgage insurance. So those HOA and mortgage insurance, a lot of times are things people don't factor into their debts when you need to factor that in. So again, you kind of just, you look at those types of things and then you see, okay, am I at 50% or less? If I'm not, then where is it that, is there a place I can get more income, or is there an area I can pay off some debts? So that's kind of the rule of thumb now.
I have a question.
Sure.
Would it be better to buy? Okay, so I live with my mom,
Mm-hmm.
and I'm interested on the house, but at the same time, I'm interested on creating my own equity. And sometimes I wonder, even with her, we talk about it, if it's better if I buy her house, which is not in a really good area, but it's not really that bad neither. It's not the worst. Or if I should just go and try to get a townhouse or a condominium.
So that's really going to kind of come down to personal preference a little bit, because as far as lending goes, whether you're buying your mom's house or a condo or a townhouse or a single family home, the pre-approval, you're going to be pre-approved, or the qualification is going to be the same. So the advantage to buying your mother's house is she can do what's called as long as there's equity in the home, she can do what's called a gift of equity for your down payment. So there are ways that you can actually buy that house without having a huge down payment if as long as your mother is willing to not, because a down payment basically, you got to look, the seller, right, is getting the, you owe. So the way that it works on the selling side is you still owe, your home's worth $500,000. You owe $200,000 on your loan. You sell it for $500,000. All the fees come out of it. You end up netting about $100,000, right? Well, as long as your mom is okay with not netting any of that money, then she can do what's called a gift of equity for the down payment. And then we qualify you on what the loan balance will be after that. But again, the qualifications on your mom's house condo is all the same. So, as far as it just may be a little bit easier to buy your mother's house as long as she's willing to not, get many proceeds from that sale. But, as far as the qualification goes, it's the same as far when lenders look at you. It's not going to be, oh, this is your mom's house, so the debt to income ratio is going to be different. It's still going to be the same. So it just might be a little easier if your mom's willing to give you that gift of equity.
Got it. Thank you.
Mm-hmm. Anybody else? Come on, guys. I'm smart, but I'm not that smart. No?
I know back in the day, I used to see there were escrow was like 60 days, and now it seems like it's only 30 days. What is the difference? Do you know why people are just doing 30-day escrows these days?
Yeah, that's interesting. You should bring that. Yeah, it was different. I don't know why the change came. That 30 days is kind of the industry standard now. I will tell you this though, with everything that's going on now, because mortgage lenders are so busy with the amount of refis that we're doing because interest rates are low, I'm seeing a lot more 45-day escrows than I have in the past. Only because it's just we're so busy, it's hard to get things done in 30 days. But to answer your question, I really don't know what made the difference, but it is negotiated between the realtors. So it's not like it has to be 30 days. If you and the seller decide 60 days is the kind of escrow that you guys want, that's fine. That's totally fine. It's whatever you guys agree upon between 30, 45, or 60. So again, there's nothing that says it has to be 30 days or not. So like I said, and I am seeing more 45-day escrows right now, because I think the reason is that because of the inventory is so low right now, that it's more difficult to find a home, and so sellers are more apt to maybe do a 45, because they have to go buy a house. Usually they have to go buy a house, right? So we've seen 45-day escrows be a little bit more common.
Thank you.
Mm-hmm.
I have another question.
Sure.
You were mentioning that buying a condominium or a townhouse will be much better than renting. My question will be, is it recommendable to buy a townhouse or a condominium to put a for rent? Not for me to live in, but it's a business to rent to somebody?
Okay, so yeah, I mean, ultimately, I'll say yes to that, but if you don't live in the property, so there are 3 different types of properties. There's primary residence. You buy a residence and you live in it. That's your primary residence. There is second home, which means that you will have a primary residence, but you buy a second home, and your second home has to be more than 50 miles away from your primary residence. So it's not like you can buy a residence and then buy a second home down the street. It has to be far away. And then the third is investment property. So what you're talking about is doing an investment property. When you're doing investment property, you have to put down 25%, okay, to buy an investment property. Now, let's look at the situation where I've seen a lot of people do this, and this is what I would suggest. You buy that primary residence yourself. You're going to live. Now, when you're buying primary, there's so many more advantages. You get like 3%, 3.5% down, so on and so forth. You buy that place, you live in it for a year, then maybe you can then buy another place and then rent that out, because now you're going to buy another primary residence. This then becomes an investment property, but because you already own it, you don't have to do anything different. You can just start renting it out, right? So you don't have the requirements of 25% down and things like that. You can say, okay, now I'm gonna go. Now, between you and me, so nobody else listen, you could buy that. You could buy that condo, live in it for 6 months, go back and live with mom or dad, and just start renting it out. And then again, it becomes a quote unquote investment property. So you could buy the primary and then move out, but you have to live in it. I think, like I said, I think it's 6 months or that you have to live in it for a certain amount of time. But you buy it, you live in it, you're like, you know what, I can't make these payments anymore. I'm moving back home, so I'm going to rent it out. So that is, I've seen people do that from time to time.
Oh, wow. Great. That's a great advice. Thanks.
And I also want to talk about condo, townhome versus condos and townhomes. As mortgage lenders, we look at it the same. There's no difference. If there's a shared wall, we look at it the same. Interest rates are a little bit higher, and usually there's HOAs, and HOA payments are ridiculous, because I've lived in a condo before. They're pissed, they are upsetting, because all they do is fix the freaking grass, but they go against your debt to income ratio. So there's a lot of times when I tell people, yeah, we can look at condos, because back in 10, 15 years ago, condos were $250,000 and homes were $500,000. Well, now condos are so expensive that you'd be surprised if, you know what, maybe I can go look at a single family home that is, a little bit more expensive than a condo, but now that I don't have that HOA payment, I can qualify for more, because now I don't have that $350 debt working against me. So that's, again, something else that we can look at in, I'm going to say it, your pre-approval. That's something that you'd be surprised nowadays that a $400,000, you could probably afford a $500,000 house versus a $450,000 condo, just because of that HOA payment's not there. Anything else?
I'm sorry, I do have one more question.
Sure.
Is the debt to ratio, the debt to income ratio included with the mortgage you're going to be picking up? Is that what you were talking about?
Yes, you have to factor that into your debt. So you have, right now you're renting, and you have, $200, or you have some credit cards. Your total credit card payments are $50 on this one, $100 on this one, $50. So it's $200 in credit card debt. You have a car payment that's $350, and and that's it. So, but then you have a mortgage payment that's going to be $2,500. Now you got to factor. So now your debts are $2,500 plus the $350 plus the $200, right? So that is what that debt is going to be. So that's why you have to factor that in. And that's why it's really important to figure out exactly what that payment's going to be. And so again, that's why I would find a good mortgage calculator. If you don't do a pre-approval, then at least look at a mortgage calculator so you can figure out what that is, and go through the sheet to find out what your debts are, to be able to figure out that debt. So that will tell you, my debts are, $3,800. Well, okay, now I know my income has got to be, $7,200 or 76, whatever it is. I can't do the math. $7,600. But
Okay.
and then again, remember, it's your gross income.
Okay, thank you.
Mm-hmm.
David, we have another question. Would you recommend a townhouse or condo for a first-time home buyer?
Kind of like I just talked about before. Again, it depends on if you can find one that's, $300,000, $350,000 in a nice area. You can then townhouse and condos are fine. But again, they're getting so expensive that And there's that HOA fee, that really, I cannot tell you how many loans that I've tried to do that I can't qualify because there's a $350 HOA payment. So when it comes to first time home buying, price is way more important than townhouse, condo, or single family home. Okay. And as a matter of fact, with townhouses and condos, your interest rates are actually going to be a little bit higher because, remember, as lenders, we always look at risk. If there's an attached wall and condo A catches on fire, there's a condo B might be catching on fire. Whereas a single family home, because it's separate, interest rates are a little bit better because they're more protected. So, when somebody, condos and townhouses, it really comes down to price more than anything. And I try and look at single family homes first because you don't have to deal with the HOA payment.
I have another question.
Mm-hmm.
So if a house costs $400,000 and you put down the 20%, which will be $80,000.
Mm-hmm.
So that means the loan is gonna be for the $320,000 only?
Correct.
Okay.
Yeah. So it's the loan amount and it's that loan amount that we're going to qualify you on, not what the price is. I got to make, as a lender, my biggest job is to make sure that you can repay that obligation, right? So I want to make sure you can pay that loan back. It's better for you. It's better for me, but it's going to be a loan amount, right? So let's take a step back to something. I don't know if I've said this before. It's called a pre-approval. When we're doing a pre-approval, I'm pre-approving you on the loan amount, okay, not the sale price. My point is, let's say I pre-approve you for $400,000 loan amount. You can buy $1 million house as long as you put $600,000 down and your loan amount's $400,000, right? So it's the loan amount that's more that we're really looking at rather than what the price is. So in your description, yeah, and putting 20% down on that number, we would be we'd be qualifying you on the $320,000. Does that answer your question?
Yes, thank you.
Okay.
David, we have another question. Could you use part of a retirement plan for a down payment first-time home buyer?
Yes. So yeah, let's get into that just for 1 second. Because something I didn't mention gift funds. I want to talk about that for a second. So when you are using your 401k or retirement, first of all, you have to make sure that you can, okay? Because they're 401ks, sometimes you can, sometimes you can't. Most of the time for purchasing a home, they let you borrow against it. But we need to see that loan that you have with your 401k. We got to see what the loan parameter details are, and whatever you have to pay back, we use that as part of your debts. Now, usually they're pretty good about how much you have to pay back at a time, and it's usually over, I think it's 10 years or something like that. So it's definitely something people do, and it's definitely something that I would advise. Yeah, let's take a look at it. So you can do it. You just have to make sure that you're allowed to do it, and that we figure that into the debt to income ratio. Let's talk about gift funds for just 1 second. Most of these programs do allow for gift funds for your down payment, meaning that you can, from your parents or your brother or your sister or your aunt and uncle, as long as they're willing to sign a gift letter, which we'll provide for you, that says, I'm giving Johnny $50,000 for his down payment. He does not have to pay me back. This is a gift. As long as I have that form, you can then use that as part of your down payment. Now, again, between you and me, if you guys decide to set up something behind you that you're going to pay them back, that's fine with me. As long as I have that gift letter saying to me as the lender that you don't have to pay it back, that's all I need. So there are a lot of programs out there where you can use a gift for your down payment, which can be very, very helpful. And we've, I do them all the time. Anything else?
Doesn't look like there's any further questions coming in on the chat.
Okay. right, should I stop the? Here I am again. In case you forgot what I look like. Ugh, that can't be good. So, again, any other questions?
Last call for questions.
Okay, I believe that. So actually, you know what? Let me go back to sharing my screen real quickly, because I think the last page. I want to put this up there real quick. I forgot the. So of course now I'm trying to get there and it's not going quickly, unlike before. Okay, there is all of my information, my email, my phone number, my cell phone number. If you guys please want to either take a screenshot or however you do it, or write it down, or take a picture on whatever you want to do. If you take a picture, don't include my picture because that's not good. So when later on or tomorrow or down the road, when you're like, oh, I wish I would have asked this, or oh, I forgot to ask this, please feel free to shoot me an email or give me a call. I'm happy to answer any questions that you guys have, because it always happens where you go, oh, I forgot. Or if you want to get a pre-approval done, also feel free to give me a call. I know that the folks at South Bay are fantastic when it comes to lending, and so those guys can definitely help you out, definitely answer a bunch of questions for you as well. They're one of the best credit unions out there, so I definitely feel like, definitely reach out to them. But if you want to reach out to me too, again, here's all my information. So, and with that, so I'm going to take this down. Again, if anybody has any last questions.
Looks like we're good. And then also a follow-up, we will be sending out the recording of this session or this webinar, as well as the slides and helpful links that David had spoke about. We'll be sending out David's contact information, as well as Yvette, who works with South Bay Credit Union on our mortgage team. So that would be a direct connect that you could reach out to. We will be sending that info out to all the attendees today. And we want to thank everyone for their participation. The questions were great. A lot of interaction and really great questions asked. So we thank you all for your time. Look out for that follow-up email with all the recordings and links, and have a good night, unless there's any sneak questions going to come in at the last minute. Otherwise, we will call this meeting to an end, and thank you all for attending.
Thank you,
everybody.
David.
Thank you,
David.
Thanks.
Thank you, everyone.
My pleasure.
Bye. Thanks again.
Thank you. Have a great evening.
You too.
Thank you.
Thank you.
Do you guys want to talk tomorrow?
Yeah, sure.
Just do a quick recap on how everything went.
Yeah.
All right, so I'll reach out to you guys tomorrow. We'll do a quick.
Perfect. Thank you so much. There was one member attendee that was hanging on. I was trying to remove her before I answered you. Yeah, I can send out maybe an invite time, see when everyone's available, just to touch base.
Yeah.
I thought it was great. Great questions.
Yeah, I thought it was really good. I thought it was great.
Perfect.
So
Okay.
then great attend. I mean, there's quite a few participants. That was good.
Yeah, so we had about 40 registered, which only a handful of those, and then to have it was about 15 non-employee attendees, which is great for us. One of our first webinars, so it was great. I'm happy with the results. So perfect. Yeah,
So,
I'll reach out to you tomorrow and send maybe
tomorrow, Thursday, I mean, whatever. This week, it doesn't have to be tomorrow. Just anytime this week's fine.
Okay, I'll touch base with the team and then get back to you.
Okay, sounds good.
Perfect. Thank you so much, David.
Thanks. Have a good evening.
You too. Thank you.
Bye.